The global financial landscape is characterized by a variety of markets that allow the exchange of currencies, stocks, bonds, and other financial assets. Among these markets, the domestic and foreign exchange, forex, markets are pivotal, playing distinct yet complementary roles in the global economy. While both markets facilitate currency trading, there are several fundamental differences between them that influence how they operate, their participants, and their impact on the economy. In this video, we will explore the top 10 differences between domestic and foreign exchange markets, highlighting the unique characteristics that set them apart. 1. Scope of operation. One of the most notable differences between the domestic and foreign exchange markets is the scope of their operations. The domestic exchange market focuses on the trading of the local currency within a specific country. It is regulated by that country's central bank and financial authorities. On the other hand, the foreign exchange market operates on a global scale, facilitating the exchange of currencies between countries. Forex is not confined by national borders and operates 24 hours a day, 5 days a week, enabling transactions across different time zones worldwide. 2. Currency involved. In a domestic exchange market, the currency traded is the country's own national currency. For example, in the United States, the currency traded on domestic markets is the US dollar, USD, while in the United Kingdom, it's the British pound, GBP. In contrast, the foreign exchange market involves the trading of multiple currencies from different countries, such as the euro, EUR, Japanese yen, JPY, Australian dollar, AUD, and Swiss franc, CHF, among others. Forex enables the conversion between currencies based on exchange rates, allowing for international trade and investment. 3. Market participants. The participants in domestic exchange markets primarily consist of domestic businesses, banks, investors, and individual traders who are involved in buying and selling the local currency. In contrast, the foreign exchange market sees a much wider range of participants, including global commercial banks, central banks, hedge funds, multinational corporations, and even governments. Forex traders often seek to profit from fluctuations in currency values, while participants in domestic markets are more likely focused on day-to-day business operations and maintaining currency stability. 4. Regulation and oversight. Domestic exchange markets are typically regulated by national financial authorities, such as the U.S. Securities and Exchange Commission, SEC, or the Financial Conduct Authority, FCA, in the UK. These regulatory bodies set rules to ensure fair trading practices, transparency, and stability within the domestic economy. Conversely, the foreign exchange market operates across multiple countries, with a range of regulatory authorities overseeing the market in different jurisdictions. However, due to its global nature, Forex is not as centrally regulated as domestic markets, which can lead to discrepancies in rules and oversight. 5. Trading hours. Domestic exchange markets usually operate during standard business hours within a specific country, which means trading is limited to certain times of the day based on the country's time zone. In contrast, the foreign exchange market is open 24 hours a day, 5 days a week, due to the involvement of multiple time zones around the world. Forex trading begins in Sydney, then moves to Tokyo, London, and finally New York, ensuring that the market is always active somewhere in the world. 6. Liquidity. Liquidity refers to the ease with which an asset can be bought or sold in the market without affecting its price. Domestic exchange markets tend to have relatively high liquidity within the country's own currency. However, they can be more limited when compared to the foreign exchange market, which has a vast global pool of liquidity. Forex is the largest and most liquid financial market in the world, with a daily trading volume exceeding $6 trillion. Enabling quick execution of trades and minimal price slippage. 7. Market accessibility. Domestic exchange markets are more accessible to individuals and businesses operating within a specific country. Local investors and traders can easily participate in these markets through banks, brokers, or trading platforms. In contrast, the foreign exchange market requires access to global financial institutions, brokers, and platforms, which may not be as easily available in every country. However, with the rise of online trading platforms, access to Forex has become more widespread, enabling even retail investors to participate in currency trading. 8. Exchange rate determination. In domestic exchange markets, the value of a country's currency is typically determined by local factors, including inflation rates, interest rates, economic growth, and fiscal policies. Central banks play a crucial role in influencing exchange rates by adjusting interest rates and implementing monetary policies to stabilize the domestic currency. In the foreign exchange market, currency exchange rates are influenced by a multitude of factors, including interest rates, geopolitical events, international trade, market speculation, and the economic policies of multiple countries. Forex rates are highly volatile and can change rapidly in response to global events. 9. Purpose of trading. The primary purpose of trading in domestic exchange markets is to facilitate local economic activity, such as imports, exports, and financial transactions within a country. Businesses and individuals typically engage in trading to conduct day-to-day operations and hedge against risks related to currency fluctuations. The foreign exchange market, however, is more speculative in nature. Forex traders aim to profit from currency price movements by buying and selling currencies based on economic and political developments. While international trade and investment are key drivers of forex activity, the market is also heavily influenced by traders seeking to capitalize on short-term currency fluctuations. 10. Impact on the economy. Domestic exchange markets play a crucial role in the stability of a country's economy by ensuring that the national currency remains stable, thus supporting domestic trade, investment, and inflation control. Central banks and financial authorities intervene when necessary to manage the value of the currency to ensure economic stability. The foreign exchange market, meanwhile, has a much broader impact on the global economy. Currency fluctuations in the forex market can affect international trade, cross-border investments, and even inflation rates in various countries. Major forex events, such as sudden devaluations or fluctuations in the value of the US dollar, can have a ripple effect on global markets. The domestic and foreign exchange markets play pivotal roles in the global financial ecosystem, but they operate in fundamentally different ways. While the domestic exchange market is primarily concerned with trading a country's own currency and supporting local economic activities, the foreign exchange market facilitates the exchange of multiple currencies on a global scale. By understanding the differences in scope, currency involved, participants, regulation, liquidity, and trading hours, it becomes clear that both markets serve unique but complementary functions. Whether through managing local economic stability or driving global currency fluctuations, both markets are integral to the functioning of the world's financial system.